Good evening and welcome to our advanced taxation class for today. Today, we are going to be taking oil and gas taxation part 2. Part 1 was quite an exciting time because we talked about many things that has to do with taxation, the theoretical part. One of the things we learned in part 1 was that we have two categories of people that are into oil and gas upstream activities. Of course, we said there are upstream activities, there are downstream activities. When we look at the upstream activities, these are activities that has to do with when you start exploring oil for commercial purpose till when you win them out from the ground. Of course, collecting the oil mining license, oil exploration license, down to when it is ready for export. You take them to where they are going to be exported. Upstream section done. The downstream starts from the transportation, the actual exporting it, down to the refinery process, down to selling it, marketing it to the final consumers or to the semi or to other agents who will now market it. These are downstream sector. We said in the upstream sector, we have two players, people that are into the joint venture. So you are going to do a joint venture with NMPC, and we said that those people, one of them will be the operator, and this operator will get the mining license, do exploration, do every work in it. And when it is time to contribute money, they will call for cash, which is called cash call. So you take the money, you contribute the money, and when it is time to contribute the money, you collect the money. Cash call. Who is calling me now? Pay a higher cash. Okay, so that's for the cash calls. Now we said that they don't run a higher risk. They and if they make a loss or they didn't find oil, any cost that they incur will be reimbursed. But we also said that their their tax rate is 85%. 85% of their assessable profits. We also mentioned that their capital allowances are going to be charged at we have three categories of capital allowances. We have the investment allowance or the petroleum investment allowance, of course, which depends on location. And the location is going to be onshore has a percentage, offshore has percentages based on the, the sea level. So you calculate the PIA. Then we also have the annual allowance, and we said annual allowance is just for 20% for each year up to the fourth year. In the fifth year, it's 19%. When you add them up together, if there's any balancing allowance, you add them up, you have your capital allowance on the one hand. The second capital allowance you are going to compare it with is to find 85% of your accessible profits less 170% of your PIA. And we said PIA is only going to be calculated on the year in which the asset is being used, the first time it is being used. And we said it is based on actual year basis, January to December. And we also mentioned that for the first 2 months, they're going to send estimates. First 2 months, they're going to send estimates, after which they are going to divide the total tax amount into 12 equal parts, which they will start paying from March of the first of the current year down to February of the next year. But when it gets to December, they would have gotten the real amount. So from January to February, they will start preparing what the real amount is. They have up to 6 months to prepare the audited account. So even if they pay everything up to February estimated, when they want to prepare and they find the 13th amount, which is going to be the actual amount, it may be higher than what has been paid in estimated amount. And so they will pay it within, okay, it's 5 months they give them to audit their account. So they'll pay it within 21 days. So that's for the other ones, which is a joint venture. Then we have the PSC, production sharing contract. And I told you in the last class that if the question tells you PSC, production sharing contract, or deep offshore inland basin, these are all similar words. If the question does not contain any of these, then I'll tell you it is not a PSC. And we said when it is PSC, just activate your set of 50%. The first 50% comes with the capital allowance, which is taken at 50% of their assets. The other one, the annual allowance is 20%. This one is just 50%. The second one is their investment tax credit. Investment tax credit is also 50%. I think their tax rate also is 50%. So just be looking at 50, 50, 50, unlike the joint ventures. We're going to be looking at it when we are solving a question. Now, we said when we want to know the value or the tax that is payable, once they are done their exploration, they take the risk. If they don't find oil, they lose. Now, when they find oil in commercial quantity, now what happen is that they are going to now pay. They will not call for cash calls, yes. What they will now rather do is, once they have finished production, NNPC and others will come and collect their their own cuts. The first thing they will collect is the royalty oil. Then the next thing they will collect is the, they will ask them to collect their cost oil. After the cost oil has been removed, then they will now look for profit oil. From the profit oil, they will not charge tax oil. And then NPC will now ask them to help them sell their own portion. They will give them incentives. Now, some of these things that we are talking about now in oil and gas taxation has changed in reality. It has changed in reality, but we are still looking at the immediate past, because what has changed in reality is not being tested in your exam. That's why we see the likes of Dangote selling for NNPC, and it is causing a problem. And they are saying, I don't want to say this because this is a recorded video. So, but now we know that uh, once this has been charged, all their responsibilities has been paid for, the operator will be asked to help NNPC to sell their own products. Then we said the value of oil sold. How much is the value of oil sold? We gave the composition. The value of oil disposed. These are what is sent to the refinery. Then we also have other incidental expenses. Then we also look at the allowable expenses for the petroleum or the oil and gas taxation, and I told us about education tax. It will never be given to you, but you must know that education tax is part of the allowable deductions and you have to calculate it. And I told us how to calculate it. We are going to see that today when we are solving a question. Then we are going to look at how it is being taxed. Now let's go straight to what we have for today. We have the concept and computation of posted prices and adjusted posted prices. What is this term? Posted price and adjusted posted price. Now, look at posted price. Posted price in relation to any crude oil exported from Nigeria by a company means the price free on board (FOB) at the Nigerian ports of export for crude oil of the gravity and quality in question, which is from time to time established by the company after agreement with the government of Nigeria as to the procedure to be followed for the purpose of its posted price for the crude oil and the quality. So what it means here is posted price. Let's use Dangote as an example. Dangote is an exporter of crude oil, right? Now, the posted price of crude oil is going to be what it is being the price free on board at the ports where this oil is being exported. And they are going to look at the quality of the oil and the gravity of the oil. These two things will take be looked at before agreeing on what will be the posted price. So every posted price must bear a fair and reasonable relationship to one, the established posted price of Nigerian crude oil of comparable quality and gravity, and or if there is no such established posted price for such Nigerian crude oils to the posted price at the main international trading ports of comparable quality and gravity, due regard being had in either case to freight differentials and other factors. We'll talk about this. So normally every price must be comparable, must be the same, comparable to the quality and gravity. You're going to be seeing some things like degree. You're going to be seeing some things like you look at the API. API is the degree of gravity of the oil. So now we are saying that the posted price for each type of crude oil will is what they will look at it based on the degree and the quality that is comparable to what is being priced at the international market. Now, we know that every oil have sulfur content in it. So the degree of sulfur content, the amount of sulfur content will help us to know what the degree or gravity of oil is. And these are the terms we usually hear recently when Dangote began uh, selling oil. Most of us only read it on textbooks, but now we know that there is a sulfur content when there is when oil is being produced. Just give me a moment. Okay, I'm back. My laptop was about to off. I had to find a way of charging it. Now, the measurement unit for crude oil for posted price purposes is called degree API. API means American Petroleum Institute. So for every oil you are exporting or dealing in, there must be a specific gravity measurement approved by the API. So they name it after the institute, API degree. Now, posted price are usually quoted in dollars. So it means here that because it is dollar is what is being used internationally to do exports. So posted price is quoted in dollars. So in our questions, you'll be seeing posted prices in dollars so that it can be used to compare. So you cannot quote posted price in naira. So normally when you are hearing the prices of oil, you see how many dollars per barrel. Now, what they are not telling you is the API. You're just hearing the amount it is being sold per barrel. But the next question you should be asking is, what is the API gravity? Because if there are different API gravity, the amount will not be the same. All right. For every degree of API that is above the standard API, there is going to be an increase in dollars. Let's say the increase is $0.03. That is 3 pence. So for every 1 degree rise in in API, let's say the agreed API is 30 degrees. Now, if you are exporting 31 API degree or degree API, it means comparing 31 to 30, this is 1 degree higher than the standard. Now, if the API price happens to, let's say, $20 per barrel, you are going to increase your price by that agreed degree increase. If it is agreed that for every degree API increase, you are going to increase your price by 0.03, it then means that instead of selling at $20 per barrel, you are going to sell at $20.03 per barrel. Now, assuming now you come with 29 degree API instead of 30, you now reduce your price by 0.03. So the higher the sulfur content, the lower your API. All right. So you see that's why Dangote is saying that he has to reduce the sulfur content so that we'll be having quality, higher quality of API of oil comparable to the standard. Now let's look at this example. If the posted price of a crude oil of 370 gravity, somebody's asking, somebody's saying, are we doing tax or science? I like that question. We are doing tax and we're also doing science. If the posted price of a crude oil is 370, right? So the posted price here is 370, of course it's dollars. Okay, if the posted price of crude oil of 370 gravity is $31.70, and there is an adjustment of $1.15 for every degree fall below 370. Okay, if the actual gravity is 330, that means the posted price shall be adjusted to accommodate the fall. And so this is what happens here. So it means that the posted price, we said the posted price, this posted price of 331.70, the gravity, is 370. And now that is the standard gravity. So the agreed posted price and the standard is 370. And now you are now bringing your own to post of 330 gravity. So there is a fall. There is a fall which is 370 minus 330, which is 40. And they said if there is any fall, you multiply that fall by 1.15. So 40 times 1.15 gives you, um, I don't think this is 40. It's a typographical error. Let's check the calculator to see what was actually used here. Let's see. 370, 370 minus 3330, because it's 40. I like to multiply it by 1.15. It should be giving me 46. Okay, so to show that it is not, it is 37 degrees. I thought as much. There must be that degree. So this is, the gravity is measured in degrees. So this is gravity. So this is 37 degrees. So this degree was supposed to be up here. So this is supposed to be 37 degree. And this is supposed to be 33 degree. Then you now bring 33 degree. So that will give you the difference here is 4 degrees. So what they did here is 1.15 multiplied by 4 degree. So let's do it again. 1.15 multiplied by 4. That's what gives me this 4.6. So because this is lower than the standard, we are going to remove it from the price. So it means that your posted price, your adjusted price. So you are adjusting your posted price. This is the posted price, which is the standard. Now you're bringing something less than standard. You need to adjust your posted price. So it is now becoming adjusted posted price. So we'll be seeing a lot of adjusted posted price. Someone says, is this similar to normal loss in PM? I don't want to talk about PM now, but let's see as we are going. If there's any similarity, I will let you know. So we just learn how to calculate the posted price. So posted price, they will give you the standard, and you will now compare what you are bringing with the standard. If there's any fall from the standard, your posted price will be adjusted accordingly to give a lower amount. Now, look at the format for computation of petroleum profit tax. When the details of production and sales are given, that is the number of barrels sold, both locally exported and the prices per barrel, you'll be seeing it here that fiscal value of chargeable oil. Now, this fiscal value of chargeable oil, this is including the exports and the local sales. So normally the export will be number of barrel times the posted price. It could be adjusted posted price when we look at the API. Then the local sales is just number of barrels times the selling price. Now this will be in naira, this will be in dollar, then you multiply by the exchange rate to get it in naira. Then you get the fiscal value of uh, oil. This is the fiscal value of chargeable oil. Okay, then this could be um, um, value of oil disposed, sold to the refineries or taken to the refinery. We said disposed, you are not selling it, you are transferring it. Add them up, now add all other incidental income. When you add the incidental income, you are now getting profit for the period. Then you will less allowable deductions, including education tax. Then you will now get account adjusted profit for the period. Then of course you will remove unrealized loss brought forward. You will now get accessible profit. You will now bring your capital allowance, which is restricted to the lower of actual allowances, and 85% of accessible profit less 170 of petroleum investment allowance. Chargeable profit, then you get your tax at 85%. Hmm. Now we have a question here. Okay. Now this question seems to be loaded. All right. We'll look at the solution as we are solving it. Bongboniche Limited is engaged in petroleum business. You have been given the following information with respect to the company for the year ended 31st December 2015. And we are saying that it is being done on actual year basis. As you can see in the solution, year of assessment 2015. It's actual year basis. Take note of that. Then we look at local and exports. So this is a crude oil in barrels. Look at what is being exported in the market. This is what is being sold locally. Then we look at the applicable posted stroke selling prices. Now, I still don't understand how these are being arranged. Sundry income, recurrent administrative purpose, still yet to understand how these are being arranged. Let me see the solution so that I can understand. Okay, so they separate it into local and exported. Okay, I get it now. So in the case of this, the local is here, the foreign, the export is here. All right, so this is the royalty on oil sold. Then we have the qualifying capital expenditure and all of that. So we look at the additions for 2015 are classified as, so the assets that are being added, and they told us the debt, custom duties, additional information, sundry income includes, okay. They also told us other things. Then let's look at what they are asking us to do. For the year of assessment, calculate the next net fiscal value of oil of chargeable oil. Okay, net fiscal value of chargeable oil. Okay, they say state the year of assessment. That's the first thing. The year of assessment is 2015, computed on actual year basis. So that's no brainer, but we can still write it down here. This is our own illustration one. Illustration one. What's the name of the company again? Gogo Niche Limited. Gogo Niche Limited. The A part, year of assessment is 2015. So this is actual year basis. Now the B part, we are asked to get the for the year of assessment, calculate a net fiscal value of chargeable oil. Fiscal value of chargeable oil. B1, fiscal value of chargeable oil. That's what we want to do now. So these things tend to run into millions. So I will be forced to put three zeros. Okay, so what did we say is our calculation of fiscal value of oil? We said before want to refresh our oil value of oil, chargeable oil. Okay, fiscal value of chargeable oil is that for royalty purpose. Okay, that for royalty purpose plus any cost of extraction of that oil plus any cost incurred for the company in transportation and storage of that oil at the place of its disposal. Let's see. Let's go down here. And looking at this question, let's look at whether there is, okay, in the additional information, is there anything that relates to income, sundry income, okay? Sundry income is just the only income in the additional purpose, additional information. So the value of chargeable oil will start with export. Export sales. Now the export is how many barrels? 395,086. 395,086. Then what is the price here? This is the applicable posted price, 57.065. 57.065. So let's multiply. down our calculator. Just a moment. So bring our calculator. This is 395,086 multiplied by 57.065. That will give us 22 22,546. 22,546. Since I've put three zeros here, then I will come here, local sales. Local sales, how many barrels did we buy? We sell 662,594. 662,594 multiplied by 0.27. 0.27 naira. So let's do that. We have 662,594 multiplied by 0.27. That gives me 179. 179. I've put everything in three zeros and I add these two together. 179 plus 22,546. That gives me 22,725. Okay, so what else? This sundry income, all these are expenses. So this is the value of fiscal value of chargeable income. So if you look at it now, you see this is what they didn't put three zeros, they put everything. So when they add these two together, they've gotten that 22,725. Is it 725 we got? 725 based on our approximation. So that's the same thing here. 22,725. So this is the fiscal value of chargeable oil. Now, let me tell you, it doesn't matter if it has been sold or not. That's why they didn't tell you the fiscal value of chargeable oil sold. Fiscal value of chargeable oil, whether it is sold or not, it is taken as sold. So that's one thing we should know. It's taken as sold. Even the ones that is being sent to the refinery, you see, it was not sold. And if there was refinery, we would have added it to that. So these are our fiscal value of chargeable oil. The next thing we are asked now to do is to look for total income, which is this B2. B2, we're looking for total income. The total income will be fiscal value of chargeable income, which is what we did before. We have 22,725. Then we have sundry income. Sundry income. How much is the sundry income? We are told that sundry income, we add this to here, 681,301, 681,301. So I will say 681,301 plus 122,999 plus 122,999. Then there are adjustments they made us know here. They said sundry income includes profit of 4,185. I think I should put everything in the. I think I should not put the three zeros so that my answers will not look funny. So permit me to redo the first one. 395,086 times 57.065. So let me do 22,545, 583, 583, 545, 5, sorry, 583. I don't want my answers to look funny. 583. I've chopped off a whole lot. Then let's do the second one. 662,594 times 0.27. That gives me 170, 178,900, 178,900. Now if I add this 225,455,583 plus 178,900, and I get 2272483. So that is 4483. So let me take it down here. So it's the same thing I'm going to put here. Four, 483. All right, so it's fine. Now I'm going to the sundry expenses. Sundry expenses, we are told that it contains income on disposal of assets for which appropriate approval has been obtained. When you dispose an asset is not supposed to be part of your income. So you have to remove it. 4,185. So I'm going to remove this 4,185. So I'll add, this is 681,301 plus 122,999 minus 4,185. So your sundry income is 800,115. 800,115. Now these are the only two income you have. So your total income is going to be, add it to this 227,24483. That gives you 23524,598. 23524,5, I get it again, 598. All right, so let's see what The suggested solution is saying that's the same thing. That's the same thing. That's fine. The next thing now is we'll look at accessible profit. Now, this is where I want you to pay special attention. Accessible profit. So total income is easy to get now. So you have D3 accessible profits. Okay, so for you to get your accessible profit, you have your total income. So in case we are not asked to break it down, you will just have been going continuously. But because you have been broken it down, you take it the way it was. Your total income continue from the last place 23,524,598. Then you are now lessing allowable deductions. Sometimes they will tell you it's section 10 of the PPA. Section 10 of the Petroleum Profit Tax Act gives you the allowable deduction. So it's not compulsory to say section 10, but if you put section 10 to impress your examiner, it doesn't add any mark to you. So what are the allowable deductions here? Let's start with the ones in the note. It said territorial waters. Okay, this is capital allowances. This number one is additions. Number two is also additions. Good. The following additional information has been made available. We've done with sundry income, so this is done. Done with this, so let me tick out the ones we've done. Done this, we've done this, done this and this, done this and this. So let's look at the information here. Recurrent administrative expenses include donation. So we are going to be looking at this. We said donations are not approved. So let's go to recurrent administrative expense. Recurrent administrative and production expense. That's the first thing we should do. Recurrent admin expenses. So we'll have here exports, local, less disallowed. Okay, so what is the export? The export is 2,146,125. 2,146,125. Then the local is 448,490. 448,490. 448,490. Sorry, is it 448? Yes, 448,490. Okay, then the disallowed. So as I'm taking them, I'm marking them off, taking this, and I'm marking them off here. 5,008 5846. 5846. So this is donations. These are not allowed. So when you add them up, so no problem. Then the next one is, let's see another one here. Oil palm research. Okay. Now we also told here that other expenses here We have intangible development expenditure. Intangible development expenditure. We have export, local, 669, 669, 684, 669, 684, 669, 684. For local, 121, 650. Then we are done here. Exploration and appraisal wells expenditure. We just want to believe that this is for the two appraisal wells. All right. Then we have 1432,061. 1432,061. What is it called? Intangible development expenditure. No? Exploration and appraisal well. I'll call it exploration, exploration and appraisal wells. So this is export and this is local. So for local, we have 260, 260, 129, 260, 129, 260, 129. Then we have royalty on oil sold. Royalty on oil sold. We have export and local. Export here 4671, 4671,812, 4671,842. Is it 842? 812, 812. Okay. Then for local, 38,291. Right. So we are done. We are done with all the expenditures here. We are done with all the expenditures. Okay. All right. So what we simply do, these are the allowable expenses. We're going to add them. So let's get our calculators working. We start with this 2146,125 plus 448,420 minus 5846 plus 669,684 plus 121,650 plus 1432061 plus 260,129 plus 4,671,812 plus 3,8,291. We have 97,82,326. 97,82,326. 97, 97, 82,326. So what do we call this? This one is allowable deduction excluding tertiary education tax. So we will now look for tertiary education tax. So the way I'm doing this is how you should do it. This tertiary education tax is also part of it. So tertiary education tax, you have to do it by walk-ins. You have to do it by walk-ins. Now, when we get our tertiary education tax, we are going to add it here. Sorry, we are going to add it here. Then, when we add it, we will get our our adjust allowable expenses, which we will add to this, and we will get something here. Then we will minus what we have from this figure, we are going to get our accessible profit. So our accessible profit will be somewhere here. So I will just give it now accessible profit, which is what we are asked to look for, accessible profit. So how do you calculate your, so let's call this workings one. How do you calculate your tertiary education tax? So we come here, workings one, TET. Now, your TET, you need to first of all bring your total income. Total income happens to be 23,524,598. 23,524,598. Let me see if I have it. 524,598. Yes. Then you will say less allowable expenses excluding TET, which is what we just have here. 9782,326. 9782,326. So you will less this. So whatever you have here is accessible profit inclusive of TET. Now this is allowable expenses excluding TET. So there is no TET here. There is no TET in this. So this is your income. And when you remove these expenses, what you have, since there is no TET here, that means the TET is inside this answer. The TET is inside this answer. So this is what we have before. I'll put a minus sign to it. Plus 23,524,598. So this is 13, 7 2 13 742 272. Right, so this is your accessible profit inclusive of TET. Therefore, TET is equal to, I think it's 2%. As at when? What year of assessment are we doing? For the Finance Act 2019, TET, yes, this is 2015. So tertiary education tax is 2%. So it's going to be 2 over 102 multiplied by what we just gotten now, 13,742,272. So just look for multiplied by 2 divided by 102. So your tertiary education tax is 269,456. 269,456. 269,456. Let me be sure. 269,456 approximately. So that's it. 269,456. So I'll bring it down here. 269,456. So now if I add these two six nine 456, if I add it to 9,782,326, that will give me 10,051,782. All right. Now, if I were to remove this from your income, 23,524,598. 22,524,598. Then this is my accessible profit. 13,472,816. So this is the 100% accessible profit. Now, can you check now? This is smaller than this. This is 13,472. This one is 13,742. This is because accessible, the tertiary education tax was inside here. But now the tertiary education tax is out from here. To check if your figure is correct, look for 2% of this figure, of this your accessible profit you just calculated now. You look for 2% of it, whether it will give you tertiary education tax. So let's check. 2%, so let's say multiply by 0.02, it gives you 269,456, which shows you that what we did was correct, because tertiary education tax is 2% of accessible profits. But the reason why we went through all this long journey is because as at the time we want to calculate tertiary education tax, we don't know accessible profits. But we only know that this figure here, this expenses here, which is up to here, does not contain tertiary education tax. So if you are to remove this from the income, this profit here has tertiary education tax in it. So what it means is that 100% of accessible profit is there, plus 2% of accessible profit, which is the TET, is also there. So we need to take out that 2% out of the 102. That's why we did 2 over 102 times this figure. This figure has 2%. This is 2% higher than what the accessible profit should be. This is because of the tertiary education tax in it. This is comparable to when we are doing VAT inclusive and you want to remove VAT from the VAT inclusive. If you have a VAT inclusive of let's say 107,500 and you want to remove the VAT element and VAT is 7.5, all you need simply to do is 7.5 over 107.5 times that amount. That's the same principle we are using. And when you do that and you get the accessible profits, go back and check if you do 2% of that accessible profit, whether you to give your TAT. If it does, then you are on the right track. Now we've calculated our accessible profit. Let's see what the suggested solution is telling us. It will not be materially different. Okay, we didn't bring, oh, we didn't add our custom duties. Wow, why did we miss it? Custom duties. Oops, we didn't add our custom duties. So we'll need to adjust everything we have been doing. And there was a loss brought forward. How come I missed it? This solution, okay, there was no loss brought forward. So we didn't add our custom duty. So that's the only thing we need to adjust now. Let's adjust it now. Let's find a way of inserting it. Let's bring it in here. Let's say custom custom duties. Let's see what we will do. Custom duties. The custom duties for the year ended, this is 2014 and 2015. We're only going to take that of 2015. If you see, they didn't take that of 2014. It's just the wow, they did workings on royalties. So let's see the workings they did on royalties sold. If it is the same thing. Okay, I'm not particularly bothered about that. The custom duties. Let's just take what was given to us here in 2014, 2015. We won't take that of 2014 because everything is actual year basis. So we take 1710. So let me just insert 1710. Just insert 1710. So what I will now do to lighten our load, I will add this is 97, as I'm recalculating this, 9782326. The only thing we just added is 1710. 1710 is the only thing we just added. So if we add it, this is 9784. So just 4036. 4036 is the only thing we are changing. 4036. We'll redo the TET. So 4036. 036. So we'll redo it. So we'll remove this from 23,524,598. That gives me 13,470,562. 0562. Okay, so we'll adjust it here again. So look for 2 over times 2 over 102. So this gives me 269,423. 269,423. 423. So we take it down here. Okay, so we have 9,784,036 plus 269,423. We have 10,053. So it's 3459. 3459. I'm going to adjust. 3459. What happened? 3459. Now take it away from 23,524,598. I have 13,471,1139. 1139. Let's see if it's the same thing we got. There seems to be something different, but that's not a problem. Let's see what they did in theirs. Rent and admin expenses. Let's see the workings. Two that was done here. Rent and admin. Let's see as recurrent admin. We have this one, okay, plus this one, and they added them together, and they now deducted this, and they get two, okay, they now deducted 5846. Of course, so that's the same thing we did, okay. And let's see their workings. Three, intangible development, tangible development, 2 5. Let's see what we did. Tangible development, 255, 258875. Where did they see that figure? Okay, where was that figure given? Can't see any of that kind of figures here. Okay. Exports let's see, exports 699,586,684. Then the other one here is 121,650. Of course, it's the same thing here. So royalty on oil sold, I still don't understand where they got this 2557. Still don't understand where they got it. So that's something I can't fathom from this question. So I will not take the answers as being correct because everything we've done here, we've taken it from this question. So I don't know where that one was coming from. So we'll leave that one as it is. We have our accessible profit as this. This is our accessible profit. Now the next question is asking you to get your capital allowance. Capital allowance. What is your capital allowance? So the next thing to do is B3, or is it B3 or B4? B4 is capital allowance. B4, you have capital allowance. Now, the first thing to do is to look at your annual allowance. So we start with annual allowance. Okay, so we look at your assets. The year is, so what we will do now is the year we are looking at is 2015, right? And I will just say minus 4. What I mean now is 2015 minus 4 is 2011. 2011. So 2011, 2012, 2013, 2014, 2015. So this 2011, any asset bought in 2011, you will charge 19%. So, but anyone up to 2015, you'll be charging 20%. So look at your qualifying expenditure. This is 25. The rate here, let's be adding a rate. The rate here is 0. This is 0. This is 20%. This is 20%. This is 20%. So you see why we need to do all of this so that you will know where the cutoff is. The cutoff is 2011, 19%. Anything earlier than that is 0. So you can decide to do it that way. So you can come and put you can say year of assessment. Okay, you can do it this way. Year of assessment, qualifying capital expenditure, rate, amount. So you can do it that way. All right, so we start with 2005. So you can say 2005. Qualifying expenditure is 1,266,890. 1,266,890. The rate is 0% dash. The next one is 2006. Qualifying capital expenditure 68,151. dash. Next one is 2020. 2013. 2013, of course, is 20%. 65,468. 65,468. Look for 20% of that. 65,468 times 0.2. That's 13,094. 13,094. Then the next one, 2014. Sorry, it's 2013. Then we have 2014. We have 277 277,902. 277,902. Of course, it's 20%. 277,902 times 0.2. I will give you 55,580. And the next one, sorry, I want to tick all the things I've used. Custom, I've used this. I didn't use this. Okay, so I'm done with this. I'm done with this. I'm done with this. I am going to done with this. That's 2014. So I am on 2015. 2015 is now before I do 2015, I know this is 2015, right? Now if you see this figure, this 608050 comprise of this and this. So if you add them together, it gives you this figure here. So we need to understand that these are the two figures that became this. So this is the one that is acquired in this year. 608050. 608050. 608050. So this is 2015. Of course, it's 20%. Okay, so what do we do? 20%, 608050 times 20%, that's 121,610. 121,610. So this is your normal capital allowance. This is your normal capital allowance. So you add them up. This is annual allowance. Okay. We don't even prorate. We don't even prorate. We don't even prorate. So don't come and think about prorating. 121,610 plus 55,580 plus 13,094. Now this is your annual allowance, 190,284. So this is your annual allowance. That's not all. The next thing we are looking for is petroleum investment allowance, which we call PIA. We have established that this is a joint venture. This one does not have PSC in this. It doesn't have PSC. So that's why we are calculating annual allowance as 20% and all that. and petroleum investment allowance. We are going to be looking at it now. We are going to look at all the asset that was bought in 2015 is what we are considering in the PIA, because the PIA is for, like, it's just like investment allowance or initial allowance that is charged on the first year of use. It's like investment allowance, yes, that is charged on the first year of use. So 2015 is the reporting year. Any assets bought in 2015 qualifies for PIA. So what we will now do here, you will say assets, location, rates, and amount. So for PIA or JV PIA, we look for location. So the first one is additions. They said operations in territorial waters. Okay, we'll not put of we'll not just say assets. The asset will just say operations. Location, offshore, offshore 0 to 100. Offshore 0 to 100 meters. I think it's is it 5%? Okay, that's something I didn't put. We should have put before the rate. We would have put the cost, rate, because the rate is 5%. What's the cost? 208,050. 208,050. While the other one is 400,000. This is beyond 20. So offshore above 200, that should be 20% operations. So let's check back if we are correct in our offshore. This page 587. Okay, 10%. Okay, onshore land is 5%. The first one is 10, 15, 20, so it's 10. Okay, so the first one is 10%, not 5. It's onshore that is. These are not going to be given to you, so you need to know them. So 10% of this should give us 2805. 20% of this should give me 80,000, because 10% is 40, 20 should be 80. You add them together, they should give you 10805. So that's your PIA. Now that we've gotten this, is there any balancing charge? There's no balancing allowance. So that means we are done with this. We are done with this. Okay. So done everything that is asked of us. So let's calculate our capital allowance. Now say, therefore, capital allowance, say higher of, higher of, is it higher or lower of? It's lower of, it's lower of, is the lower of. First one is A, annual allowance. Annual allowance is what? 190,284. 190,284. Petroleum investment allowance, which is 100,805. Add them together. So this is 9, 8, 10, 1, 9, 291, 291. So there's 291,089. So this is your A. Then you say B. 85% of accessible profit. So 85% of accessible profit is 0.85 times, what's the accessible profit here? What's the accessible profit? Accessible profit is 13,471,139. Let me write it well here. 139. So 13,471,139. 139. Is that 139? That's fine. So let's look for that. So 13,471,139 multiplied by 0.85. That's 85%, which is 11,450,468. Okay, 11,450,468. Now, less 170% of PIA. So that means it is 1.7. 1.7 is 170% multiplied by the PIA we calculated right now, 100,805. 100,805. So we look at it now. 1.7 multiplied by 100,805. That gives me 171,369. 171, 171,369. Now when you minus this, what do you have? So when you minus this from here, you have 111,450. 468. So you have 11 two 11 279 279,099. So you have 11 279,099. So now you say, therefore, the capital allowance is the lower of this. This is what you have acquired as capital allowance, and they said it should not be higher than this: 291,089. 291,089 is your capital allowance. Let's see what was done here. 291,089. So that's what was done. I don't need to look at their workings because we did it in the same way. Yes, we did it in the same way. Okay, so that's it. Then we're asked, after getting your capital allowance, we need to find the chargeable profit. What is your chargeable profit? That's B5. B5 chargeable profit. The chargeable profit is simply your accessible profit. What is the accessible profit here? Okay, we calculated what we did here, yes. Accessible profit is 13,471,139. Yes. Then less capital allowance. So less capital allowance, which we've just calculated as 291,089. So we have 13,471,139 minus 291,089. So that will give us 13,180.50. Our answers are going to be different because of that figure that they got, which I don't know. So that's their chargeable profit. They have 14,000, 14 million something. It's going to be different. Then the next one is B6, chargeable tax. So the petroleum profit tax is going to be 85% of this is chargeable profits of chargeable profits. So it's going to be 85% of 13,180,050. So times 0.85. That gives me 11,203,042. So that's okay, 043. So your that's your tax. So that's your tax. Now this is the tax that you're supposed to pay. Now let's assume that If this is supposed to be your estimated tax, it is this amount that you are going to divide into 12 and be paying monthly. Now, let's say this is the actual tax that you are supposed to have paid. And maybe your estimated tax happens to be 10 million sharp. The difference between this 11 million 1,203,043, which is 1,203,043, that difference will be paid within 21 days after you've calculated and determined the annual tax, the actual tax. Now, assuming that your estimated tax was say 12 million, and this is your annual actual tax, that means you have paid more than you're supposed to have paid. It means that the difference will be deducted. So it means that you will now revise your your estimated tax again and remove the difference and work with it. So your estimated tax will now change to reflect that difference. So that's how this is being calculated, and I know it has given you guys some stress, but with practice, you are going to know what to do. We'll still do some practice more, but let's talk more about tax offsets. Tax offsets. What is tax offset? We have the Memorandum of Understanding. With effect from 1st January 1986, the government of Nigeria entered into an agreement, that is during the Shehu Shagari regime, right? You know, um, I think it should be, it's either during the reign of Shehu Shagari or Buhari regime, the first military regime. Forgotten which one of them had this arrangement. They entered into government, entered into arrangements with the oil producing companies. This is because of the oil price depression. The oil prices were so getting low, people were not looking at the oil sector as kind of being, lucrative. They are making losses. The cost is high, and they are selling the prices at low cost or low prices, and they are not being encouraged. More so, some people will lose all their investment if they didn't strike oil. So memorandum of understanding was granted that certain incentives will be granted to them. To the following objectives was for the purpose of that MOU: to encourage crude oil exports, to encourage investment in exploration and development activities. This is a risk for the PSC companies. If they don't see anything, the investment is gone. This is a very huge investment, so they want them to explore, encourage them to do those exploration activities, encourage investment in area of enhanced oil recovery projects, encourage investment in gas utilization projects, encourage increased lifting and sale of NNPC's crude, equity crude. So the parts that NNPC is supposed to sell, the ones they could not sell by themselves, these people should sell for them, effectively reducing the tax impact on companies engaging in petroleum operation. Now, you still wonder, that with these incentives, the tax rate happens to be 85%. And I don't know. Now, the MOU applies to petroleum companies operating joint ventures with NNPC. So this is for only those that are in joint ventures, not those ones that are having PSC. As we discussed, the PSC may have joint ownership with NNPC, but mostly they are not in joint ventures with NNPC. They are mostly on their own operation. The purpose was this incentive was to guarantee a $2 per barrel profit margin after tax and royalty. So it means that if after they take your tax, your profit after tax, when you want to sell per barrel, everything, the whole price plus tax, everything after tax, you should be able to guarantee that you make at least ₦2 per barrel profit. So it should be ₦2 and above. So with all the things that they are taxing them, they need to give them that incentive so that they can be able to make not ₦2, sorry, $2 per barrel. And now, in those days when the dollar was and the naira was so strong against the dollar, you can imagine what $2 per barrel was. Compare it to now. So $2 is like 3,000 something naira per barrel. So you can imagine how much profit they are supposed to be making for each oil that they sell. And they produce thousands of barrels of oil. All right. To the oil company at a notional technical cost of $2 per barrel over the sellable price. All right. So just know that this MOU is to guarantee this profit. So now, the format for granting MOU. When we have the chargeable profit, which we did before, we will calculate our chargeable profit and we calculate our assessable tax. If we have our assessable tax, we will not need to remove the MOU. So if like this question had an MOU, after we've calculated our assessable tax or so, which is at 85%, we will not need to remove the MOU from the tax. That is to reduce your tax. So your MOU is for reducing the tax that you are supposed to pay. Now look at the conditions under which the incentives can be granted, penalties for non-compliance. That's one, the company gave the following undertaking to lift crude oil in which NNPC is unable to lift out of NNPC's equity share of joint venture and to carry out a work program mutually agreed between NNPC and each of the oil company. Now, when a company is unable to lift all or part of the volume of NNPC, NNPC levies a penalty of 2% of the average realizable price for each barrel not lifted. So the price that you are supposed to have realized, the price that you are supposed to have realized, if you have lifted it, you find it out, they will charge 2% of that price. That's the penalty. Such penalty is not allowable as a deduction in the calculation of PPT. So it means that you should be able to lift it and sell. That's why you see oil business is a booming business. People want to sell oil by all means. So you must lift it and you must collect it. And when you collect it, it means that whether you sold it or not, you have to pay the amount to the NNPC or to the federal government amount. If within 3 months of service of notice the condition is not remedied, the incentive cease to apply and PPT is completed on pre-1986 basis, whereby there is no MOU. So the MOU is if you have agreed to do that, followed by those conditions, then you are going to get that MOU that is being reducing your tax. Now let's go to investment tax credits. Now I said investment tax credit is for the PSC company. With effect from 1999, look at the NNPC, the investment tax credit, the crude oil producing company which is executing a production sharing contract with the Nigerian National Petroleum Corporation in 1993 shall, throughout the duration of the production sharing contract, claim investment tax credit as an offset against tax in accordance with the provisions of the sharing contract. Now, applicable rates is 50% of chargeable profit for the duration of the production sharing contract. In computing the tax payable, the chargeable tax, that's the chargeable tax, the investment tax credit shall be applicable in full to the petroleum operations in the contract area. So what it means here is, look at the format. Let's look at the format now. Assessable profit at 85%, sorry, accessible tax at 85% of chargeable profit. Yes, that is in as we calculated before. Investment tax credit 50% of chargeable profits is going out. Then your chargeable tax is this here. Then you can see now this chargeable tax now can be shared. NNPC will take its own percentage, the oil producing company will get their own percentage. So it means that the 50% is just like where we did IMOU, the way we did MOU. This MOU is for um, joint ventures here, and investment tax credit is for the PSC company. Additional chargeable tax. In Section 9 of the PPTA, the calculation of the profits of an accounting period is expected to be based on actual proceeds of sale of crude oil as made by the company. For instance, if the actual selling price of 1 barrel of crude oil is 40 naira and the company exports its own crude at say 10 naira, on the basis of the provision of Section 9 of the PPTA, the company's accounting profit for the year will be calculated on the basis of 10 naira per barrel proceed plus all other sales that is being produced. So it means that normally the actual selling price is 40 naira and the company now export its own at 10 naira. It will not be calculated on 40 naira, but it will be calculated on 10 naira. $10. You keep saying naira, sorry. What could make someone not to sell at $40 but to sell at $10? This is not as a result of API. API, no. I want to suggest that it could be subsidy that was added. So they put a subsidy and they subsidize it, and government is taking that of $30 and the person is selling his own at $10 because government is giving the balance of $30. And so uh, that could be one of the reason. And when they say now that they want to remove subsidy, it means that extra $30 that they are paying to these people to sell at 10 naira, they are not going to pay them again. So they will now decide to sell their own at the higher price. Okay. Section 23 was introduced partly for the purpose of discouraging such abuse and to ensure that sales of crude oil made by companies engaged in petroleum price operations are made at prices that would align with the market price. So I don't think it is subsidy that will cause this. So it means that if they are selling market price is 40 and you are selling your own at 10, maybe you want to do a price war, a competition, so that people will now buy more from you than from this other market. They now want to stop the abuse. So they said the actual proceed of sale of crude oil are computed applying the actual selling price. So somebody who sold for $10 will use $10. The resultant figure is used in the computation of the accounting profit and chargeable tax for the accounting period. Then B, a sort of notional sales proceed of crude oil exported. That is what the sales would have been if you had sold at the market price will be computed. This is referred to as posted price in place of the actual selling price. So they will use the posted price and now calculate, and they will now calculate the price or the sales that you would have made. The amount arrived at will be used for computing of the profit as well as the chargeable tax for the company. Now, the chargeable tax arrived at by applying the posted price is compared with that arrived by the actual selling price, and the higher of the two will be the final tax for that company. So what it means here is if you are selling for $10 where you should have sold for $40, they will calculate your profit, calculate your tax. They will also calculate what your sales or revenue would have been if you sold at market price. They will calculate your tax. Whichever is higher in the two will become your final tax. So it means that if you are sold low and your tax is low, they are going to give you additional assessment. That's why you're seeing here additional chargeable tax, section 23. So don't be surprised, it may come out in the exam. It has not been tested before. Artificial transactions. This has to do with um, artificial transactions. We've talked about transfer pricing issues. All right, so let's talk about um, Finance Act 2019. Prior to the implementation of Finance Act 2019, the dividends paid from petroleum profits are exempt from withholding tax. That is before 2019 Finance Act. Any dividends you pay from petroleum profits are exempt from withholding tax and is not liable to any form of tax. So it means that if dividends is paid to a petroleum company, instead of collecting that 10%, they give them the whole gross. But Finance Act 2019 amended Section 60 of the PPT Act, and they are now subject to withholding tax. So they are now subject to withholding tax. So in case you are calculating your tax and you have suffered withholding tax, after your tax has been calculated, you can now say less withholding tax. So you can see how many things are we lessing. We've calculated your assessable tax. For those who have MOU, you remove your MOU, you get your chargeable tax. You now less your withholding tax to see your tax payable. In the case of those with ITC, when you remove your ITC, you still need to remove withholding tax that you suffered if you suffered anyone. All right, so we're going to skip some of these things here. He said allowable tax deduction and tax incentives for marginal field operations are, he said this last time, 65.75 tax rate for operators yet to fully amortize their pre-production cost. So this is for the first 4 years, which is 48 months. Sorry, is it 5 years? I will check if it is 5 years, which is 60 months, or 48. I will confirm that. Used to think it's 48. Zero tax rate for gas transferred from natural gas to liquefied facilities. Then 30% tax rate for upstream gas income. So gas income, even if it's upstream, gas income is 30% tax rate. Then accelerated allowance at 20%, and petroleum investment allowance from 5% to 20. The same thing here has been done. Losses may be carried forward indefinitely. Exemption from further tax in the form of withholding tax on dividends. We need to read all of these. Then this registration requirements, don't need to talk about that. It's still the same thing that you know in the other companies. This is business sold or transferred, not that important in the calculation of. This is merger and acquisition. That's merger and acquisition issue. This is revenue service powers to call for returns. This has been taken over for appeal and objection and appeal procedures. You need to read that. Unit of currency, all income tax computation made under section 30 and 33 of PPTA shall be made in the currency in which the transaction was effected. Of course, even though the API, the posted price is in dollars, you need to convert it to your currency in which the transaction is to be effected. This assessment and appeal procedures, we don't need to talk about this because it's still the same thing as what you know for other companies. So sometimes I usually tell people that if you want to study all the topics in one, just come and read PPT, or oil and gas taxation, to comprise of all the topics. Most of the topics are being treated under here. So what it means here that we have effectively covered this topic Sorry, my network. So I will go back to where I was. Right. So we said here that for 2 months into the accounting year, you need to submit a returns of estimated tax, and the first payment of that estimated tax will start from the third month, the ending of the third month, which is March 31st. And you'll be paying it from March 31st up to February of the next month. When the accounting period is less than 1 year, it shall be prorated. Subsequent monthly installments are due and payable not later than the last day of the month in question. Then the final installment is due and payable within 21 days after the service of the notice of assessment of the accounting period. The amount of this final installment is the amount of tax assessed for the accounting period less the total amount paid by the 12 monthly installments. So it means that, look at it here, look at the summary of dates. The first installment is due and payable 31st March. Second one is due April, May, June, and you do the 12th installment is due on February 28th or 29th. So that is when the 12th is due and payable. So the 13th is not stated here. It is 21 days after that notice has been served. Tax subject to objection and appeal. I need to talk about that one. If any installment of tax is due and payable is not paid within the appropriate time, penalty of 5% of the amount of the installment shall be added and become payable. So this is penalty, repayment of tax, tax deducted at source. All right, these are withholding tax. And I said, if you want to study everything about tax, just pick the petroleum profit tax and just read that chapter and go to the exam hall. Most everything that you want to know about tax is in that chapter. Theory part. Now we come to natural gas. Tax on sale of natural gas. Natural gas means gas obtained in Nigeria from boreholes and wells and consisting of primarily of hydrocarbons. Now, chargeable natural gas in relation to a company engaged in petroleum operation, this means natural gas actually delivered by a relevant company to the Nigerian to the NNPC under a gas sale contract. Now, non-associated gas. On the other hand, in Nigeria, we do not have exclusive gas reservoir that may or may not include any amount of crude oil. So non-associated gas is defined as natural gas not in contract, not in contact with reservoirs that contain significant quantities of crude oil. But normally, associated gas is involuntary production of oil. Involuntarily production produced with oil. It means that, like I said before, you are doing the business of oil, but you now got gas as an accessory. You went to buy phone and they are giving you earphone charger as an accessory. So that is how associated gas is. Non-associated gas is different. You went to the market like to go and buy earphone You went to the market to go and buy charger. It's different from you went to market to buy phone and you got charger and earphone. So that is how you should understand the associated gas. Now, the value of natural gas. Now, most times now, if this natural gas is associated gas, it is added to the profit of the petroleum company, and all of them is added as petroleum income that is charged at 85% tax. Now, sometimes they are treated differently, especially if it is non-associated gas. For a petroleum producing company, the ascertainment of the value of all natural gas in the accounting period shall be the gross proceed, which is called J factor. Okay? The gross proceed under the gas sale contract less the J factor, okay, less the gas factor. So what it means is that the contract price given to you will be given to you. Then there is what they call load factor, or they call gas factor. The load factor or gas factor is in the form of degree. This is 50, this is 60, this is 70, this is 80. So as the higher the degree, the lower the percentage. This will be given to you in the exam on a question that requires gas. This will be given to you. So gas factor, now look at how we need to calculate it. So we use what they call the interpolation factor. Use the interpolation rule. I will explain this rule for you when we are solving a question. All right. So let's see this question here. It said, where the load factor, if you are given two load factor, so if you are given um, you are given two gas contracts, you are given two gas contracts where one of them is 56, the load factor is 56, so I will call it load factor. So let's say gas one, this is load factor, this is percentage. Then gas two, now we have 56, we have 72. That is their load factor. Just like API, this is their load factor. What are their percentage? This percentage is what will be used in reducing the contract value. So now we'll take gas one. Say, let's say gas one. Now, this 56, we'll go to where we have 56. Now, 56 lies somewhere here. 56 lies somewhere here. So it's between 50 and 60. So what you do, you look for the upper limit, which is 60. So we're looking for the percentage. Looking for the percentage. So you have the upper limit is 60 minus what we have here is 56 divided by upper limit minus lower limit. So 60 is the upper limit minus what you have here is 56 all over upper limit minus lower limit. Now let's look at their percentages. For 60, it is 15.5. For 50, it is 16.9. 15.5, 16.9. This is 15.5. Let's check again. 15.5 for 50 is 16.9. Sorry, for 50 it is 16.9. So this is 16.9. This is 15.5. Now, this is 60. Look at the corresponding figure in percentage. This is 60. Look at the corresponding figure. This is 50. Look at the corresponding figure. Now, this is 56. The corresponding figure should be, let's say, X. Now, that is how you do it. So now, how will you find X? So you will say 60 minus 56 will give you 4. 60 minus 50 will give you 10. This will give you 15.5 minus X all over, that will give me 15.5 minus 16.9. That will give you minus 1.4. Minus 1.4. You will now do something called cross multiplication. You will now say 4 multiplied by minus 1.4 will now be equal to 10 multiplied by 15.5 minus X. So when you multiply this 1.4 times 4 minus 1.4 times 4 will give you 5 minus 5.6. So this is minus 5.6 equal to this multiplied by this will give you 155 minus 10x. All right. Now we need to take like terms. Now I want this x because it has minus here. I want it to move to this side. So it has minus here. If it moves to this side, to become 10x, right? So this 10 migrated to this side, comes from minus to plus. This 155 stays where it is. Now this one has minus, migrates to the other side, it becomes plus 5.6. Or you can decide to say, okay, leave this x here. This is 155. It goes the other way, it becomes minus 155. And everything will be minus, minus, and you will still become the same thing. Now, this is 10x will give you 160.6. Therefore, x will be 160.6 all over 10, which will give you 16.06%. So this 16.06% is the percentage for a gas of 56. So can you say that it is between 15.5 and 16.9? So it is 16.6. That is what it is saying here. That is what 16.06. That's the same thing we got here. 16.06. So it is this percentage. Let's say your gas contract is 2 billion, or say 2 million, right? You find 16.6% of 2 million and you remove it like a loss, like a discount. That is your discount factor also. And you will now sell at the net. That is what is being said here, that value for any petroleum company, the ascertainment of the value of all chargeable natural gas shall be the sum of the gross proceeds under individual gas sales contracts less the G factor allowance. So this G factor allowance is what we just calculate, the G factor percentage. Then we use that percentage to multiply the gas contracts to get the allowance. So that's what you should know. So if you look at um, these are the look at an example here that was given to us here. Um, you take your time to go through it. This is the load factor, and still don't understand what they did here. These are this is load factor 50, 75, 80. This is the amount of contracts, billions. Okay, so this is the load factors. I'll put it in percent. This is in degree. This is in million. This is in million. This is in million. Okay, if we are to do one of them now, I did 50. I won't do 50. Let me do 75. 75 is between 70 and 80. So if you look at it now, that one that is 75, let's see, Oroola Limited. Okay, let's calculate that one as an example. So we say 75 is between 70 and 80. And for 70, what is the factor for 70? 14.3, 13.6. 14.3, 13.6. So now let's calculate what 75 would be. We say it's going to be 80 minus 75 all over 80 minus 70, which is 13.6 minus, let me call this one G, all over 13.6 minus 14.3. So this is 5. So that is 5% all over 10% equal to 13.6 minus G all over 13.6 minus 14.3. That gives minus 0.7, minus 0.7%. Okay, so now you now cross multiply. This will now be 5 times minus 0.7, this is percent, equals to 10, 13.6 minus G, all in percentage. So you now get it here, 5 times 0.7, which is minus 0.7, that is minus 3.5. So this is same thing as saying minus 3.5 percentage is equal to 136% minus 10G. Okay, we do that thing we did before. This 10G minus 10G becomes 10G. equal to 136%. This one crossover plus 3.5%. That gives me 139.5%. That's 10G. Therefore, G will now be 13.95%. 13.95%. That's what we have here, 13.6%. But I'm saying, I don't know how they got that 13.6. This is that. Okay, look at it here, 13.95 is the one I did. 13.95, which is 75. That's the one I did. 13.95%. That's it. Now, look at the contract price is 4.8. So this is the contract price, 4.8 million. Then G factor allowance will be 13.95 times 4.8. So you look at 13.95 divided by 100 times 4.8. That will give you 0.6696. So let me just write the thing in full. 4,800,000 by multiply this by 1 million. This will give me 669,600. 669,600. 669,600. That's what is the gas factor we are removing. So that means the final price you are selling it is 4,800,000 minus 669,600. So you are going to sell at 4,000,000, 4,130,400. 4,130,400. That's what we got here. That's what we got here. That's how gas, the value of gas is being calculated. This is the value of natural gas being calculated. So sometimes you calculate it by workings and bring it into your answer. So far, so good. We have come to the end of this topic. This is oil and gas taxation. We have come to the end of this topic. So, what remains now is practice, practice, practice. All right. So, for the next week, okay, for the next 3 days, for the next three class, which is going to be the last three class of our class, we are going to practice petroleum profit tax for the next two class at least. Then for the final class, we might have our final word. Maybe we might do a practice of petroleum profit tax. But on 30th of September, which is the last day of our class, which happens to be a Monday, we'll likely have a final word. So just prepare for the next two class. We are going to be doing petroleum profit tax. So thank you so much for the time invested in this topic. So come prepared next week when all we'll be doing is solving of questions. No too much explanation, no too much talk, solving of questions. And I tell you, these questions, there's no way you can escape it in the exam. There's no way you escape it. So these videos, this series of videos are important for you. You must pass your exam. So thank you once again. Your questions, bring them on. Ask me privately. I'm going to answer them for you. So until then, I will tell you to have a nice day and keep your questions coming. I will see you in the next class.